On August 6, 2025, a 50% U.S. tariff on Brazilian coffee took effect, halting shipments worth billions. Reuters reported that American roasters froze purchases, while Brazil turned to the WTO and rolled out $30 billion in credit to back its exporters. The Guardian described New York cafes bracing to raise prices, passing the shock directly to consumers. What was once a daily ritual is now a geopolitical battleground. If your morning cup costs more, who really pays the price? For decades, Brazil and the United States shared a uniquely stable bond in the global coffee trade. Brazil, the world's largest producer, supplied roughly 1/3 of all beans consumed in America, more than 8 million bags annually, valued at about $4.4 billion. For U.S. roasters, this flow provided unmatched consistency, while consumers enjoyed abundant supply at affordable prices. With fewer than 1% of U.S. beans grown domestically, Brazilian coffee became the invisible backbone of the American morning routine. Stability defined the partnership, but cracks began to form well before the August 2025 tariff shock. U.S. policymakers increasingly portrayed heavy reliance on Brazil as a vulnerability. Trade hawks in Washington argued that Brazil benefited disproportionately, while American farmers gained little. Despite coffee being a crop, the U.S. simply could not substitute. Simultaneously, Brazil diversified its trading partners. New deals with China, the European Union, and Canada signaled that São Paulo was less dependent on U.S. demand. By mid-2025, when Washington imposed a 50% tariff, those earlier tremors turned into seismic rupture. Brazil had options. America did not. What was once a seamless relationship now looked like a fault line threatening to split the continent's daily cup. On August 6, 2025, Washington triggered one of the harshest trade shocks in recent memory, a 50% tariff on Brazilian coffee. The White House framed the move as part of its broader reciprocal tariff doctrine, insisting it was necessary to pressure Brazil into fairer terms and reduce American dependence on foreign supply. Officials argued that Brazil's dominance, supplying 1/3 of U.S. consumption, had become a strategic liability. But the consequences were immediate. Importers and roasters across the United States froze contracts to avoid swallowing the new tax. Reuters reported warehouses full of green coffee sitting idle, shipments delayed or rerouted. Brazil filed a request for WTO consultations within days, calling the measure a violation of global trade norms. At home, Brasilia announced a $30 billion real credit package to stabilize its exporters, ensuring beans could be redirected elsewhere rather than sold at a loss. Inside the U.S., the disruption hit every level of the supply chain. The National Coffee Association reminded lawmakers that less than 1% of coffee consumed in America is grown domestically. Hawaii and Puerto Rico simply could not fill the gap. With 1/3 of supply suddenly taxed into uncertainty, roasters face stark choices: raise prices, cut blends, or scramble to secure Colombian, Central American, or African beans at higher costs. Consumers felt it within weeks. The Guardian reported cafes in New York City warning of menu hikes, while industry surveys suggested prices could climb 25 cents to 50 cents per cup. NerdWallet and Bernstein analysts projected retail ground coffee prices rising 15 to 20%. For a nation where coffee is not just a drink, but a ritual, the tariff turned morning comfort into economic anxiety. Wall Street noticed too. Shares of major chains dipped as investors braced for margin compression. Washington had sought leverage over Brazil, but what it created was a storm brewing in every American cup. North of the border, Canada moved quickly to seize the opening. Unlike the United States, Canada levies zero tariffs on green coffee. Importers and roasters began diverting Brazilian shipments to Vancouver and Montreal, using Canadian ports and warehouses as safe havens. Royal Coffee confirmed that consignments once earmarked for the U.S. were being redirected to Canada, bypassing punitive American duties. The Coffee Association of Canada pointed out that this policy gap gave Canadian buyers a powerful edge. Suddenly, Brazilian beans that were prohibitively expensive in New York were competitively priced in Toronto. Demand surged. Brazilian exporters, eager to offset lost U.S. sales, doubled down on Canada, offering favorable contracts. By mid-2025, bilateral trade data showed record volumes, not just in coffee, but across multiple commodities, signaling a deepening partnership. For Canadian roasters, it was a transformative moment. Independent shops in Vancouver reported greater access to premium Arabica lots once monopolized by U.S. chains. Some cafes marketed their brews explicitly as Brazilian beans, tariff-free, appealing to cost-conscious customers. The narrative resonated. While Americans paid more, Canadians enjoyed stable prices and wider choices. Ottawa also recognized the diplomatic leverage. Officials framed Canada as a reliable alternative for Brazilian exporters facing unpredictable U.S. policy. That reliability dovetailed with Canada's broader trade diversification strategy, which already emphasized closer ties with the EU and Asia. By acting swiftly, Canada positioned itself not just as a beneficiary of rerouted coffee, but as a structural hub in the redefined supply chain. The shift underscored a stark contrast. While Washington pursued confrontation, Ottawa emphasized openness. And the message to global suppliers was clear. Canada, with its transparent rules and tariff-free access, was the safer bet. For Brazil, long accused of being overly dependent on U.S. demand, this was liberation. For Canada, it was a windfall that extended beyond economics. It was an opportunity to redefine its role in North America's trade architecture. By late summer 2025, the confrontation had hardened into a stalemate. The United States could not easily retreat from its 50% tariff without losing political face. Brazil refused to concede, bolstered by new channels to China, Europe, and Canada. Canada, meanwhile, enjoyed the immediate spoils, but also worried about overdependence. If U.S. policy shifted again, a sudden flood of cheap American purchases could upend fragile Canadian roaster margins. Consumers on both sides of the border embodied the divide. In New York, customers grumbled about paying an extra quarter or more for the same latte. In Toronto, cafes quietly celebrated stable prices, even as demand strained logistics. Both countries were living two versions of the same morning ritual, divided by policy. The deadlock revealed a deeper truth. Coffee had become a proxy for North America's fractured economic future. One partner embraced tariffs, another embraced trade, and Brazil proved it no longer needed to rely on Washington. The beans told the story. North America was no longer united by its cup. For Canadian roasters, the sudden influx of Brazilian beans was both blessing and burden. In Montreal, mid-size roasting companies secured contracts at prices their American rivals could no longer match. One firm reported a 22% jump in export orders to Europe, leveraging its new access to Brazil's premium Arabica. Local cafes marketed the advantage with pride, posting signs, "Authentic Brazilian coffee, no tariffs here." Consumers noticed, and foot traffic rose, but opportunity carried hidden strains. Ports in Vancouver and Halifax faced congestion as redirected cargo overwhelmed facilities. Smaller roasters complained that larger corporations hoarded the best contracts, leaving independents struggling to secure steady supply. Municipal leaders warned of over-reliance. What happens if Washington and Brasilia strike a deal and flows revert overnight? Canada had earned the image of stability, but with it came exposure. A windfall of beans translated into profits today, but also logistical headaches, regional inequality, and the risk of being caught in a geopolitical tug-of-war tomorrow. In the United States, the costs hit directly at the counter. In New York, one cafe owner told reporters she had no choice but to raise menu prices by 50 cents per drink, watching customers grumble but pay. Retailers confirmed ground coffee prices climbed 15 to 20% nationwide, with packaged beans up nearly $1 per pound. The National Association of Convenience Stores projected an extra 25 cents per cup within just 3 months. For households already squeezed by inflation, The tariff became another daily reminder of political decisions. At the corporate level, roasters postponed contracts, waiting for clarity. Supply chain managers scrambled to source from Colombia or Central America, often paying more for lower quality substitutes. Warehouse stocks dwindled. Specialty chains reduced menu options, pulling affordable blends off shelves. Wall Street flagged falling margins at major coffee companies, cutting stock ratings. The US had aimed to discipline Brazil, but instead disciplined its own consumers. What began as a bid for leverage translated into empty wallets, anxious businesses, and a bitter aftertaste across America's most beloved ritual. North America's morning ritual has become a mirror of its fractured economy. The United States clings to tariffs as leverage, while Canada thrives on diverted trade, and Brazil finds freedom in new markets. Consumers now live the consequences, some paying more, others sipping cheaper. The question lingers like steam over a cup. In the race to define the future, will North America win together or fail apart by going it alone? You're American or Canadian? Share below.